So we're going to start. Good afternoon, ladies and gentlemen. A very warm welcome to all of you today. It gives me immense pleasure to announce the third LinkedIn Local webinar. Our April theme is Career Challenges During the COVID-19, and the theme for today's webinar is Financial Planning During Difficult Times. My name is Vivek Chadha, and I, along with PV Chaudhary and Colonel Amit Verma, will be your host for today. We are in unprecedented times that no one has seen before. It is through collective efforts that we can overcome this. Whatever be a situation, I want to assure you that we will come out of it stronger, and asking for help is the best thing you can do during these times. My sincere gratitude to all the panelists who found out time from their schedules to spend time with us here and gave us a chance to listen to their experience and expertise. For any questions, the panel will take them up when Q&A starts, and you can keep them ready and put them in the Q&A box that you see at the bottom of your screens. I thank all of you again to come here and participate in the third LinkedIn Local webinar, and hope that you derive value from the same. Without much further ado, I request Preeti to introduce LinkedIn Local to all of us. Thank you.
Thank you, Vivek. So, welcome again once everybody. LinkedIn Local India is a LinkedIn property. It is essentially meeting your online connections offline. So putting faces and names, to those profiles that you interact with day in, day out, or you might get connected to in the future. So that's the whole premise of this concept. With these different and difficult times, all we have done is taken that concept and taken it virtually. So here we are in a virtual form, LinkedIn Local India online, doing the same thing, basically connecting, communicating, collaborating here, learning from each other. And that's where all the value is, when people interact, when community interacts. So in that tradition, we are sort of carrying this whole thing online. Welcome you all to this very important topic of financial planning for different and difficult times. Thank you to the panelists again, and to everybody, all the attendees that are here. We hope and sincerely pray that it turns out to be a much value-added session for you. Couple of reminders, please. There will be introduction going on with the panel. Please listen to those carefully, because that would sort of, point you in the direction of the questions that you might want to address to what panel. Please be very clear and concise with your questions. Put them in the question answers box. Mention the name of the panelists that you would want those questions to be addressed to. Once this whole, procedure starts, please start thinking of those questions and putting them on. So with that, couple of things to say. Once again, have a very good afternoon, and hope to see you sometime physically in the very near future. Over to you, Vivek. Thank you.
All right, so we have among us Colonel Amit Verma, who is a part of our team. Colonel, I would request you to introduce yourself, please.
Thanks, Vivek. Hi, everyone. I'm Colonel Amit, an Army veteran. I retired last year, and I've been associated with LinkedIn Local India now for almost 6 months. It's been a tremendous journey of learning and giving back to the society. And also, I take this opportunity to sort of interact with the larger HR community and the corporate community about the military veterans and how they can get their fair share when they're transitioning. Today's topic, I'm really excited to have such a great panel, and looking forward to interacting with them. Thank you.
Wonderful. Thank you, Amit. I am going to briefly introduce the panel. We have among us Amit Kukreja. Amit is a fee-only wealth advisor and founder of AmitKukreja.com. He is based out of Gurgaon. We have Sangeeta Sumesh. She is Financial Growth Enabler for Businesses, ED and CFO at Dun & Bradstreet. She is also the author of the book, What the Finance. She is based out of Chennai. We have Anurag Bhatia. Anurag is the CEO of Minance, a wealth management firm based out of Bangalore. We have Hansi Mehrotra. Hansi is a financial coach at the Money Hunts. She is also the LinkedIn top voice and power profile for India in 2018. She is based out of Bombay. It is, it is for the first time that we have all the panelists based out of different cities. And in fact, all the panelists sitting here are from different cities. And I hope we are going to do a great job at this very, very important panel. Preeti, over to you.
Thank you, Vivek. So Welcome once again, panel. Thank you so much for being here. At this point in time, I would like to introduce the topic for the day for the benefit of everybody that's listening in, tuned in, and been so magnanimous with all the three sessions so far. So, the topic today, something which is really important and very close to everybody's heart in these kind of different and difficult circumstances. It is financial planning for difficult times. Now, I would like to invite, each of the people one by one. To begin with, Amit, please, could you share your views on what you think should be the do's and don'ts of financial planning for good times or bad, along with one of your personal hope and fear that you think, will help us or not help us when we come out on the other side of this lockdown or these enforced circumstances. So over to you, Amit, please. Thank you.
Sure. Vivek, can you help me putting up that slide as I get started?
Sure.
So I would like to share with all that this is a wonderful opportunity for us to change ourselves internally as well as externally. But talking about financial life, I would want to recommend 9 steps to change your financial life. The very first one is be cash conscious now, which means take a stock of your availability of emergency fund. Do you have emergency fund in place? Which means if you lose a job, are you there adequately supported by your money for 6 to 9 to 12 months of no cash flows arising out of salary? So make sure you have a good and adequate emergency fund in place. Make sure you are living a frugal lifestyle now. This is your opportunity to cut down your expenses. Come down to basically 3 categories: must have expenses, nice to have expenses, and discretionary expenses. Take this as an opportunity to stay on top of your insurance framework. Make sure you do not have any money back plans. You make sure that you have the life insurance, the health insurance, the personal accident disability insurance, the home insurance in place. Keep your spouse in confidence. Share all the necessary paperwork with her. Tell her where the files are located and double check the kind of cover you have for all of these insurances. Be ready for financial setbacks. That's my next one. People are losing jobs, salaries are being cut, bonuses are being rolled back. And there are also news that the offers which were made for the new jobs have been withdrawn. You may not have a salary 6 to 9 months down the line, or you may not have the increment, or you may lose whatever you're having at the moment as a bonus. All these possibilities are likely to happen depending upon which industry you belong to. So be ready for financial setbacks. Take a stock of your loans, next one, and prepay your loans as much as possible. Stay away from credit card loans, stay away from toxic personal loans. You can keep a house loan if it's giving you financial leverage, but make sure if you have the capacity to pay back your loans. Next one, map your assets to financial goals. Identify which ones are the most important goals and map your assets to those goals. If the goals are within 4 years, keep that money in debt funds or fixed deposits. If the goals are beyond 5 years, open up your portfolio to have index and equity based investments, including large cap, multi cap, and mid cap companies. Be aware of your financial behavioral biases. Don't act out of greed or fear. Next one is make a budget for new normal. Your lifestyle is going to change in a very big way. You may not be needing a car. You may be needing more sophisticated technology equipment at home. You may be working out at home. You may be needing new hobbies or opportunity to upskill yourself vertically or laterally. So keep a budget for the new normal. We don't know what this new normal is, but the new normal will force you to make changes. Stay invested in the market. We have seen whenever these markets have crashed, these are once in a decade opportunity. Here is this opportunity that you were waiting for since 2008. Increase your equity allocation. This is going to give you a huge CAGR 4-5 years down the line. Stay invested in equity if your goals are more than 5 years away. Last one, not the least, the spiritual practice of presence. Be in the present moment. Don't worry too much about what's going to happen next week or after May 3rd. Enjoy your present moment. Keep your mind grounded, centered, focus on task at hand, and enjoy your time with family and your professional colleagues in an online way. My hope, Preeti, is that this will pass in another few quarters. And my fear is it's going to wipe out some of the big industries which have been successful at a business level. And this is going to create a new industry altogether in the technology world where people will find new employment opportunities as well.
Thank you so much, Amit, for those insights. My personal takeaway from here would be definitely number 7, make a budget for the new normal. That's really well said. Thank you so much for sharing those. Vivek, we can have that away, please. Thank you. So, attendees, for your benefit again, while I move on to the next panelist, please think about all those 9 points. And if already there are certain questions in your minds, please start putting them into the question and answer section. And as and when more people will put in their views and their thoughts in force, then let's have more questions coming in. So my question now moves on to you, Sangeeta. The question remains the same. What are your thoughts on the topic, please, including one personal hope and fear when we come out on the other side of this pandemic? Thank you very much, Sangeeta. All yours.
So thank you, Preeti. Thank you. So like we know, the lockdown is creating a lot of behavioral change, and I think Amit very well touched upon it, and things are going to have a new normal. I mean, for instance, working from home is becoming a new normal, and I'm sure a lot of offices are going to move towards that, having minimal real estate requirements or opt in for co-working spaces. So having said that, I think it's very important, whether you're an individual or a business owner, cash is king. So you need to be very prudent with cash. So I'm going to give you 3 finance mantras that you can follow. So the first one being on your cash flow. Cash is king, like I already said, and while you can control your cash out, you can't really control your cash in. So all that you can do right now is to control your cash out. So how would you classify, on what basis? So before you do any spend, I would just request you to pause and take a moment to see what will be the best way. So classify them into 3 different buckets, being highly essential expenses, and non-essential expenses. Of course, highly essential and non-essential makes it easy. The gray area is the essential expenses. So let me give you a small example. Let's say you're going grocery shopping, and then you brought all your essentials like your rice, your dals, and atta, so on and so forth. But then you're also tempted to buy stuff like chips, juice, goodies, stuff like this. Now, how do you draw a line there? Now, are they essential, highly essential, or not essential? How do you differentiate? So what I would suggest is, like Amit just mentioned, to have a budget. So the budget, I would also suggest, is to have, you can do it in 2 ways. Either you can allocate a part of your salary, like let's say, for example, 50% of my salary is going to go towards my cash out for all my expenses. And then you can play around with it. Alternatively, you can also say that I'm going to spend every month no more than X amount. So you can play around with this and then see how best you can control your expenses for each month. The second tip being prioritization. Now, how do you prioritize? I mean, a lot of things are important and essential, but how exactly do you prioritize with the limited amount of resources, and you don't want to go overboard with it as well? So the first one on prioritization would be your living expenses. All your living expenses, your food, clothing, shelter, obviously you can't do without these. So whatever are your basics that are required for your day-to-day living, first prioritize that. Next, I would say, are your legal expenses. For example, your income tax or your GST, stuff like that, where you mandatorily have to pay, and you might as well pay it, because at a later date, you shouldn't get into any unwanted interest and penalties. The third is the reserves. So what do I mean by reserves? For any sort of emergencies, you must have reserves that are having a good amount of liquidity. For example, it could be some in your fixed assets, it could be a liquid fund. I mean, whatever works for you, but the idea is it should be liquid. And, it's not like you have a property which the liquidity of it takes a longer time, because in case of an emergency, you need to have liquid funds. The fourth thing to prioritize would be your investments. Now, investments, there are a wide variety. I mean, it could be real estate, gold, mutual funds, your stock, whatever. But the key is to diversify your portfolio. So I would recommend for you to have a look at your current portfolio and then see how much you want to allocate for each of these, and ensure that you are secure with your investments. And of course, last but not the least is your general expenses, wherever, whatever you think you have excess amount and you need to spend it in a prudent manner. But of course, learn to differentiate between appreciating assets and non-appreciating assets. So third finance mantra would be on your revenue. Now, if you're employed, well and good, monthly you get a salary, but it's always important, and it'll be a good thing for you to see if you can have multiple sources of revenue. So see, like, if you can have other sources of income, like your interest income, rental income, or how is it that you can go around gaining some extra apart from your regular salary income. Now, I think somebody had also mentioned in the chat, like, how can college kids go and get some money? I mean, simple things like if you're good at social media, you can probably look at digital marketing, or, teaching people on how to be more fluent with digital marketing and stuff like that, so that you are able to get some other smaller sources of revenue. So in my case, like Vivek said, I'm an author of the book. It's a bestseller. It's called What the Finance. So I do get a small amount as royalties from that as well. So with that, I'd leave it to you. I'm happy to connect with you on LinkedIn, and do subscribe to my YouTube channel as well. It's called Sang Shasum. And I hope you apply a lot of prudence in all your expenses. Best wishes to you.
Thank you,
Over
Sangeeta.
to you, Priya.
Thank you for that, Sangeeta. Okay, a reminder once again to all the attendees, let those questions keep coming in, folks. Your question and answer section is where you need to be. And with that, Anurag, it's over to you. Same question again. Your advice, one hope and one fear, please. Over to you, Anurag.
Thanks, Preeti. It's very nice to be here, first of all. I wanted to expand a little bit more about point number 4 brought up by Sangeeta, which talks about investments. This is probably the best time where you can do a lot of portfolio shuffling and additional funds which you might have. This is a great time to invest. I think that increasing your equity exposure right now will be a very smart thing to do. This drop has also taught us how important it is to have a significant allocation to fixed income instruments, debt funds. As Amit said, if your investment horizon is less than 3 or 4 years, it's prudent to have a large allocation in debt funds. And right now is a very good time to invest in Indian equities, equity, mutual funds, and also global stocks. There are a lot of companies, including Manans, another popular company is Vested, Stockal, that lets you invest globally. A lot of companies like your Amazons of the world, technology companies like Microsoft are not extremely hit. We have the opportunity which probably comes once in 5 years, where we can invest in these companies at a 20 to 25 discount to their January or their February peaks. I also want to add the importance of allocation to gold, which we have been speaking about for a while. I think that any portfolio should have approximately 8% allocation to gold, for the sole reason that it has an inverse correlation to equities. When the times are hard, when panic hits, all correlations tend to zero. However, this one has taught us that gold, we saw that gold rose by about 8% to about 12% in the last 2-3 months, whereas equities dropped 30%. So having exposure to gold helps us exit that investment in times of panic, use those gains in order to invest in equities at a cheaper price. We have to be very careful about investing in equities. Like Amit said, there are going to be major business fundamental changes. Every bull run has a leader. Financials, NBFCs were a leader. Companies like Bajaj Finance were absolutely leading the Nifty, and it might not. I'm not commenting on any one company, but that might not be the case. So this is a great time to relook at the portfolio once again, increase exposure to chemical companies, pharmaceutical companies, etc. It might also be a smart thing to do some tax loss harvesting right now, where you're letting go of your losers and you're investing in other companies. You're using the short-term capital loss, and you can offset that for the next 8 years. So those are broadly what I wanted to talk about. I'm happy to take any questions that might come forward.
Sure. Before that, Anurag, one hope and one fear that you think of?
In terms of fear, like I said, I think that a lot of businesses will change fundamentally how we interact with businesses. The food business, the hospitality business, how we interact with those businesses will change. So it's very hard to say what is going to be those fundamental changes going 1 year down the line. It's very hard to predict that. And in terms of hope, I definitely think that we're going to have a very fast recovery. The economic demand exists, economic capacities exist. It's just about restarting those capacities, and then the revenues start flowing. So I think the economic recovery from here on is not going to be a 3-year long journey like we saw post 2008. I think it's going to be a quicker 1 year to 14-month journey.
Okay. On that, I think a positive note. Thank you very much for that, Anurag. Last but not the least, Hansi, over to you. Before that, a reminder again to all the attendees, please. The questions are coming in, but then we would like to see some more, a lot more, because remember, this webinar is for you guys. That is why all the experts are sitting here to be able to address your queries and concerns. So please let those questions keep coming in. Hansi, once again, a little reminder of the question. Financial planning for good or bad times, one hope and one fear as we come out on the other side of this. Thank you very much.
Cool. Hi, everyone. Thanks, Preeti. Thanks, Vivek, for inviting me. I'm going to talk very, very fast, so I want to cover a lot of points. One is, like this webinar, you will probably come across many webinars, many articles, and everyone will have a different point of view, which means you only probably add to the confusion that you already have. So my first suggestion is that come up with a framework, come up with a scaffolding for your knowledge, so that any new article or panelist or expert that you ever hear from now on, that you're able to fit that bit of information into your framework. So please have a framework. In my YouTube channel and my website, I have given quite a few frameworks, with obviously the proviso that they are my opinions, my concepts. By all means, if something else suits better, then go for it. So one of the frameworks is to basically use the concept of mental accounting, which is all your goals. So firstly, why would you do financial planning? Why would you want to have money? Obviously, you can't eat money. You need to use money for something. So my goal was to be happy. And I worked backwards from what will make me happy. And I decided 3 things make me happy. One is meaningful work, good relationships, and so on. But you have to decide on what makes you happy. And the reason I'm saying is because as from Amit onwards, and Sangeeta also said that usually you divide your goals up into 3 buckets: needs, wants, desires, right? But they call them essential, non-essential. I just divide needs into need now and need later, but essentially needs, wants, and desires. And that's a useful framework to link it to risk. I believe, unlike what financial planners say, you have a risk profile or a risk tolerance, even regulators refer to it, but I've never come across any literature in the psychology world that calculates it. So I think that there is a better way to connect risk to these buckets. So basically, all of us want the certainty of having a basic lifestyle. We want a high probability of meeting our need later needs and our wants. And we want a possibility of getting rich. Mm-hmm. So there are 3 words I use: certainty, high probability, and possibility. That means that when you put your buckets and your goals into these 3 buckets and put them into these risk buckets, you then link your investment asset allocation to these buckets, as opposed to, again, listening to some vague asset allocation, efficient, frontier, optimized, all these words, jargon that people throw. And I know I'm a CFA, and I started as a financial advisor in '93. So I've actually been in the market for 27 years. I'm older than I look. But I'm telling you, ignore all of that and use this concept. What I did was I used these concepts, and I came up with another one called the money house, where I used the concept of mental accounting, checked with all the financial experts in the world, and they all agreed this is a good way to explain it, where imagine you are the architect and you're building a house. Okay, so one, the architect needs to know his or her own capabilities, and we need to know the lay of the land, which is what are the inflation or economic environment and who has what incentive to actually help me or not help me. Then I put the foundation under the ground, which means I hide it from people. So anything that is essential, which I put money into liquid funds or savings account or FDs, gold and house, where I do not get talked into by anyone telling me otherwise. Okay, that's my under the ground. Then I build pillars, investment pillars. One is your own skill set, and one is a long-term equity portfolio for your long-term retirement needs. And then on top of that, I build a fun roof, which is basically all the things that, one, make me happy, and two, make me rich. And I know that I can start a business, or I want to be a singer or an actor or any of those things that I may want to do in life. I can't say, oh, when I do all these other things and manage to pay off my house and manage to do all of this, then I will start living my life. That's not how life happens. So I'd say that do all three simultaneously, but you decide how much of your overall wealth you can put in these three buckets based on the certainty, high probability, and the possibility of the risk. I can tell you, using this framework, I have, as I was telling all the panelists before we started, I wanted to quit my job and be financially independent by a certain age, by a certain number. I used that, and I have been now pretty much retired for the last sort of 9 odd years. So now I take on projects that I want to, that I really enjoy doing. But most of the time I actually do what makes me happy, which is read books, listen to music, and chill. So I can tell you, coming back to your first question, financial planning for bad times, I'd say it's like everything else. Whether you cultivate relationships or build financial plans, the planning part has to happen in good times, so that you can actually benefit from it in bad times. It's very hard to actually plan in bad times. I'm going to stop there and take on any questions that I get later on. Sorry, hope and opportunity. My hope is that we actually learn from this crisis in terms of, like I said, what makes us happy. Hopefully we realize that all the things we spend time on, so for example, in one of the videos I've said, if you add all the commute times and all the clothes you have to wear and all the politics you have to deal with just to earn the money that you do, and you adjust your income, you realize your hourly rate is much, much lower than what you think it is. So I hope that people realize this. And let's not let a good crisis go to waste by not having learned something. My fear is that people will not learn something. Every crisis I've ever seen in the last 27 years, I've realized people kind of recover from that and they go back to being their old self and they don't make a change, which is sad. So,
right.
Stop.
Okay, thank you, Hansi, for that. A lot of insights and a lot of thoughts and themes for my own head to be put around. So I'll have to go back and internalize that later. But
all of that is on my side, Preeti, so don't worry about it.
Thank you for that. So before we sort of go on to the next section, here is another piece of information for the attendees today. All our experts here today are available on LinkedIn. So please reach out to them if you have any specific deep dive questions that you need answered, which we might possibly not be able to take today because of the individual nature of the question or lack of time or whatever it is. Please send out a personalized note over LinkedIn to all the panelists present here saying that you were a part of this Linkedlocal India webinar and you would like to connect to them to get some more queries answered. And they are more open and receptive to sort of connect with you that way and answer all those queries. So before we move on to the next section, thank you very much, panel, for all your valuable advice and thoughts. Over to you, Vivek, for conducting the next bit. Thank you.
Thank you, Preeti. Our next session is supposed to be Q&A. However, before the Q&A, we are going to have something very interesting. This is a very serious topic. So we are going to have a rapid fire question, which we are going to ask all the panelists. Just a couple of questions, some interesting questions, and the panelists can feel free to give funny answers. It's okay. All right, so we will start. First, we will go to Hansi. Hansi, are you ready?
Okay.
All right.
I feel like coffee with Karan right now. Okay, go, shoot.
That's right. This is Coffee with Karan.
Okay.
For just 5 minutes. What do you miss while working from home?
Nothing. I've been working from home for quite a while. As in, I don't work, so nothing. I love staying at home. I just miss going for my evening walk.
Okay, wonderful. Second question. What is your favorite time of the day?
Late night. I'm a late night person.
All right. Thank you, Hansi. Now we'll move on to Sangeeta. Sangeeta, you ready?
Sangeeta, are you ready?
Yep.
All right. Sangeeta, what is your dress code for work from home?
You know what? Just between us, I have a broken arm. So I'm like, put on this dupatta to cover myself up. So there's no dress code, whatever I'm most
That we know that you're here while
comfortable
the
in.
arm is broken. I'm saying, why don't you show your arm while everybody is watching? You've been so brave coming here, for this webinar. Okay. Second question: what are your favorite time pass activities?
Sorry, could you repeat that? The connection is bad.
Okay. My second question is: what are your favorite time pass activities?
Sangeeta, your favorite time pass activities?
I think we're having a bad connection with Sangeeta. Preeti, why don't you move forward?
Okay, all right, not a problem. So, Amit, if you're ready,
Yep.
here's my first question for you. Quarantine in one word.
Lot of meditation, lot of time with myself. I am enjoying it.
Lovely. Thank you so much. Two learnings rather, from work from home.
Well, you can always work from anywhere. I mean, I don't think there's any preference of location for me. So I can work from anywhere, any location. And the second is, it's just wonderful to be connected with my clients online and offline. It's been very seamless for me. So I was not realizing that earlier. I just don't feel the change at all for me.
Okay, thank you very much for that.
Welcome.
Over to you, Anurag. Netflix or numbers?
Netflix or numbers? It's going to be numbers, definitely. I'm not a TV person.
Okay, all right. What games do you play in your spare time at home?
Nothing really. I just play a little bit of online chess with my dad sometimes.
Okay, so still numbers. All right. Okay, fair enough. So I think we're done with our rapid fire. Vivek, again, if we can start the moderation. So over to you. Go on.
Okay. Thank you everybody for sending in the questions. Too many questions have come in, so we are going to start. Okay. The question is from Devansh Agarwal. How can a student of 2021 batch tackle the recruitment drop? How can college students become financially independent, since middle class is always the worst hit in any sort of economic disruption? I would like either Amit or Hansi to take that up.
Sorry, what was the question? How can a student of 2020 do what?
How can a student of 2021 batch tackle the recruitment drop, and how can college students become financially independent, since middle class is always the worst hit in any sort of economic disruption?
Okay, so I can tell you that when I was 21, I migrated to another country, and it so happened to be in the recession. Okay, and Australia's last recession was back in 92, 93. I suggest to young people today what I did back then, which is basically you want to figure out who you want to work for and what you want to do in life and work backwards from there. Go to those companies and those people and offer your summer internship, if you will, for free, and say, listen, I want to come. I mean, you're stuck home anyway right now. So ideally, you can do that and gain valuable experience at this point in life. Assuming you are living still with your parents and you have that basic financial backup. I know this is going to be very hard, but I used to work as a financial advisor during the day. I used to be a waitress in the evening, and I put myself through a postgrad course back then. So I come from a generation who can do sort of multiple shifts. So my suggestion would be same to all of you. I think there's no shame in working in anywhere. Even today, my best friend in Australia is saying, you know, I might even go and take a job in a supermarket stacking shelves. The point is, you do not take any of this as a setback. Just because you're doing an MBA somewhere doesn't mean you need to have a white collar job. right now I have an internship going. I have 1,600 applications. And yet when I interview these kids on the phone, some of them tell me, oh, I don't like the sound of this job. I want that job. I want to be an equity analyst. I want to be a portfolio manager. They're 21 years old. They've not completed their studies and they want to be a portfolio manager. So I find that flexibility is not there. I'd say drop that idea and become more flexible. Learn from the very people that you admire, and use this time to get new skills, new knowledge. Every university in the world has opened up their courses. Go and become invaluable to someone. That would be my advice.
Unmute yourself.
Thank you, Hansi. So the next question is for Amit. Hi, Amit. How will you see hospitality industry and the airlines in the next 1 year in terms of job creation and investments from an investments point of view? This question is from Hemant Kapoor.
This is a tough one, Hemang, and this is the most brutally hit sector because of Corona. This whole tourism, travel, hospitality, hotels, airline, cruise, it's not going to be easy to recover from this point because of the social distancing norms that we need to follow, because of also the fear that the virus may come back in a transmuted form, because also the fear that the vaccine is not going to be available easily. This is going to be the most challenging phase for people who are part of this industry. I would suggest it's just time to recalibrate themselves with respect to their skill sets, see if they can go for some more academic programs to basically grow themselves, laterally pick up something else which is likely to be needed in the coming times. You can stay in a wait and watch mode for about a quarter, but my gut is this will transform completely. This space will be the space which will go through a lot of changes. There's going to be bloodbath, there's going to be layoffs, salary cuts, bonus rollbacks, withdrawals of the offers which have been given. You are better off identifying other opportunities where you can be happy, put your lifestyle budget to upskill yourselves, change your lifestyle, and take this as an opportunity to do something different. And if things are really not that bad as I am trying to project, then maybe your job will be safe and you will get back to your normal job rigor within 3 months or 4 months. But I would like you to be prepared for a massive change. And this could be your opportunity in disguise as well. So don't fear the change, embrace it, and make a plan.
Sure. Thank you, Amit. The next question is for, let's see, for Anurag. How can a person who has no knowledge in the share markets keep a track of money so that post-pandemic, the money invested in the shares or even mutual funds will be worth full? I think the person means worthwhile. The question is from Shushmita Lunkar.
Okay. I'm guessing the best answer to this is to use an advisory service. There are so many companies there right now, mutual fund firms like ATM Money, Slipbox, which help you keep track of your investments, and they give you advice on pretty good mutual funds. So using any simple service like that really does the job. And for anything else, there are quite a lot of advisors already out there.
Okay, sure. Thank you, Anurag. The next question is for Sangeeta. This question is from Anjali Chauhan. She says, I'm the founder of a company called Maxima Steel Services, and my products mostly used in oil and gas and petrochemical refineries. And as we know, these industries have gotten into financial crunch. What do you think? How much time will it take to revive?
Oh, it's anybody's guess, but you will have to just keep track of what's going on in the industry. See if there is any ups and downs, or if it's going to impact you directly. So I would also suggest it will be good time for you to diversify, look at other options, or see where else your products or services can be utilized. You just have to think out of the box and see what is best for you in this time of crisis.
Okay. Thank you, Sangeeta. Question again for you, Amit. And I think this will be a popular question. In this turmoil, normally people would like to leverage payment dues to maximum, but do you advise to prepay the loans? So this question is from Sanjeevi Kumar Nathesan.
So, so the question is, why am I advising to prepay the loans rather than defer?
I think the question is what to do.
Yeah.
Like,
Okay. Okay. So I think the other context is also the moratorium period that the RBI had offered through the lending institutions. So my advice is simple. Keep your life simple, guys. Prepay your loans if you have the capacity to prepay. If you have surplus and your rate of interest on loans is more than the rate of interest you're earning through debt investments or fixed deposits, please knock off your loans. Sequence is knock off your credit card loan first, knock off your personal loan next, knock off your knock off your car loan next, unless car loan is giving you some tax efficiency by availing that as a business benefit for the company. Then knock off your home loan. I would say keep the home loan at the bottom of your list because it's also giving you tax efficiency under section 24A and B, the income or loss from house property. And do not take loans, especially if you are in an industry where job certainty is not there. Do not take loans. Focus on prepaying your loans. The question which was not asked, but I think there is a flavor of that question is, should we avail the moratorium thing that has been offered for EMIs? My answer is no. What is the point of deferring the payment if you have the money? You are going to be charged interest on that, and you will unnecessarily end up increasing the number of EMIs which are outstanding there, increasing the tenure of the loan. So please don't get into those tempting offers. Just keep paying your EMI as you have been paying till date. And if you have surplus, prepay your loans. If not fully, then partially. Be ready for more contingent times rather than more positive times, because I would like you to be more conservative with respect to your loans as well as with respect to your investments. Focus on capital protection first, tax efficiency next, inflation beating returns at the third level. And you can easily make a good judgment based on the horizon of the goals that you have for each of these levels of investing.
okay. Thank you, Amit. The next question again, I think, is a popular one. This is for you, Hansi. How much should we keep as an emergency fund, and how much should we keep in, say, FD or liquid fund or savings account? This question is from Inupreet Power.
So is the question how much in emergency and how much in FD, or
That's right.
should the emergency fund be in FD? I'm confused.
Differently. How much should I keep as an emergency fund, and how much should I keep in FD or liquid fund or savings account?
Okay, so I'd say emergency fund is the name of a concept. Okay, obviously it's not an actual trust. That's the concept that you should have 6 to 12 months worth of expenses in your emergency fund. You obviously can't keep it just in banknotes under your mattress. That's a very old-fashioned way of doing it. As we found out in demonetization, that's a risky way of doing it. But certainly putting some of that emergency fund into a savings account, some into FD, some into liquid fund. Frankly, I've got all three. And just recently, I diversified my bank also. My savings account also, I managed to open a second account because just in case one bank kuch problem hota hai, at least I have a second account. So, and then also I have in multiple countries. So I am one paranoid person who's got savings account, multiple savings accounts in different countries, and I've got FD and I've got a liquid fund. All put together constitutes my emergency fund, which in my case, I don't like debt funds. So I basically have a barbell strategy. So my cash runway is much longer than other people's because my fund roof and my long-term blue pillar is basically fully in equities. Therefore, I put a lot in cash. I have a good 3-4 years worth of expenses in cash, as in like in these vehicles. But it really depends on what your backup plan is. Everyone's backup plan is different. If you are young and you have a family as backup plan, that counts. If you are a government servant, technically your job is safe. So you would maybe need less of a runway than someone who's self-employed or runs a business. So I'd say it's whatever you feel comfortable to know that you can sleep safe at night. that knowing that you have the next X many months or X many years worth of expenses squirreled somewhere in one of these 3-4 vehicles.
Okay, thank you, Hansi. Let's see, the questions are coming. We have a lot of questions. The questions on investments. What are the opinions on gold and equity? Anurag, I would like you to answer that.
Okay, it's interesting. We spoke about gold and equity. I always believe that we should invest in oppositely correlated investments. This fall has shown us that gold is still oppositely correlated to equities. So I would always advise on a 8%, approximately 8% allocation to gold, so that in dire times like this, gold rises, you can exit that at a gain and use those funds to buy equities which are now cheaper. When this market crash happened, surprisingly, I noticed, and even Nikhil Kamath of Zerodha came out with a blog post where he mentioned that Zerodha has had the highest number of account openings in history. They opened 1.5 lakh accounts. So the Indian investor is no longer afraid of market falls. They want to, that maturity has come in, and they want to grab the opportunity when equities are cheaper. And in order to do that, we should have an investment parked in something uncorrelated like gold, so that we exit that and we are able to use those proceeds, those investment proceeds, to buy equities. So definitely have gold up to about 8 to 12% of your portfolio.
All right, thank you.
Sorry, can I just add to that, Vivek, just on that point of correlation, okay? Correlation is a financial concept, which when analysts tend to calculate the correlation, they do it over history, okay? So they look back over 5 years, 10 years, 20 years, 30 years. And in fact, in India, people tend to stop at 10, 20 years and think that's a long enough time. But in other markets, they do go back longer. Having said that, correlations change. In every crisis, correlations go up to 1. Okay, and as Anurag said, gold in this crisis has done better. But if you had asked any investor some years ago, should you invest in gold, they would all dismiss it, saying, "Oh, it doesn't earn income, it doesn't do this," right? So it's people's opinion changes. You should diversify across all asset classes, including gold, including real estate, including cash, including equities, all of it.
Right, thank you, Hansi. Amit, over to you for the questions.
Okay. Amit, this question would be directed towards you. The question is from Anil. He's asking, how will you see the real estate market in a year? How does it pan out? Do you think this is the right time, or maybe a time is coming when property investments will again be attractive, or they may not? What's your take on that?
Yeah, I'll be very happy to answer this question, because I'm sitting in North India, and people in North India have a lot of fascination for real estate. So it's pretty easy. So I don't think real estate will bounce back as an investment. If you want real estate in terms of a self-use home, this is your time to buy that self-use home. This is a wonderful opportunity. It's been there for the last few years. In fact, this incident has even created a bigger opportunity for you to go buy, negotiate, because the work has slowed down. The construction space is going through another labor crisis because of the unavailability of labor. So the availability of apartments is going to get delayed. The availability of units is going to be much more than what we were anticipating. So pure demand supply equation, if you apply, supply is going to be much more than demand, and hence the prices will fall down. So as an investment, stay away. As a self-use asset, go buy it now, negotiate hard and build your house. Try getting into a ready-to-move-in property, or a property which has been already there, so you can just walk in and unpack and start living, or something which is about to come available within the next few months. From the investments point of view, we have had the tax deductions which were withdrawn for real estate. And I strongly feel, at the political leadership level, this government is more focused on building houses for the people who need, rather than building houses for people who already have one. So going by that theme, the environment is going to be more conducive for the first-time home buyers than for people who already have homes. So, I mean, real estate might be charming from the tangible asset point of view, but from the financials point of view, you may want to keep a couple of homes if you are on the upper side of the income, a holiday home and a primary base home. But other than that, I personally don't think real estate will bounce back as an investment avenue, at least for next 2-3 years, once the economy, at least until the economy has been restabilized, given the crisis that we are going through, which is going to create a lot of business cycles shutting down and transformation for a lot of business models.
Thank you, Amit. Sangeeta, the next question is coming to you.
Yep.
This is to do with the discussion that we had on investment in gold. The question is, should we invest in the Paytm gold, that is the DMAT type of gold, or the physical gold? And if there are any online platforms that they should consider, which ones are safe?
Right. So gold, anything but jewelry is good, because in jewelry you lose, the making charges and stuff like that. So any other form of gold is good. The biscuits are good if you're particular about physical forms, but otherwise the Paytm gold and any such offers are also good. So you just have to take the right decision. But it's important to have gold in your portfolio as well, because that's when you're diversifying and spreading your risk thin. So maybe, like, I don't know, in my opinion, maybe about 5 to 10% of the portfolio can comprise of gold. But again, it depends on your requirements. So take a call based on what you need.
Thank you, Sangeeta. The next question is to Anurag. The question is from Sarthak. It's a pretty detailed question, but what he's asking is, what is the biggest step that you see coming from the government, which will lift back the industries, which will lift back the economic mood, and get it back to a place where we will be investing back, or we will be excited about the economy again?
It's very simple. It's a very simple answer. GST cuts. I think GST sectors which are at 18% GST has to be cut down to 8 or 12%. Those at 3% will have to go to 0% GST, and I think the 28% GST slab should not exist anymore. The highest should be 15 to 18%, and that would lead to a GDP growth of approximately about I'm guessing off the top of my head 70 to 80 basis point rise in the GDP. In the hands of the people, M2 money, public wealth, increases by about 8%, 7 to 8%. So GST cuts would be the simple answer.
Okay, thanks, Anurag. That question was also echoing what Mansoor Khan had also asked. He was expecting some sort of GST relaxation and what benefit it would give. So you've already answered that. The next question I would be posing would be to Hansi. How do you think this situation, the COVID crisis, is going to affect the startup industry? Do you see more opportunities coming up for the younger generation in investment or starting their own startup?
So how will it affect the startup industry? The answer is pretty badly, especially the last couple of days announcement in terms of blocking the Chinese investment. So I know for a fact that right this very minute, there's a whole bunch of very worried startup founders trying to lobby the government about not making it even more difficult for these the startups. So it is going to be hard. The thinking has been that in the last few years, since the internet sort of gains sort of steam, that the large companies have a advantage over smaller companies because there's a winner takes all network type effect taking place. So in all the previous hundreds of years that you study, you say that small cap outperforms large cap, meaning smaller, nimble companies tend to do better in terms of share price over large cap. That has happened in the past. In the recent decade, that is not what's happening. The larger companies are doing better. So coming back to what should you do? Frankly, I think anyone has to first take stock of their own capabilities. Even if I say startups are a wonderful idea, or if I say they're a terrible idea, doesn't mean that you can actually do it. So first thing is you take a realistic stock of what your skill set is. Are you the best or very good at something? And then go and say, there are kind of 4 ways of making money from that skill. One is you become an employee. Second is you become self-employed. In employee, you're renting a time to a company. In self-employed, you're renting a time directly to the client. Thirdly, you become a startup founder or business owner. Fourthly, you become an investor in other startup founders. Okay, so whether you invest through listed stocks or whether you invest angel investing directly into founders, the point is you have to realize what your skill set is. Some people say, okay, I can invest in this and I can invest in that, I can pick stocks, but do you even have the skill set to pick stocks? Do you have the skill set to pick funds? Do you have the skill set to be a startup founder? It's not just the idea. In fact, there was a study about all startups about why they fail, and most of them fail, in the first 5 years. They looked at idea, team, execution, capital, and timing. Guess what was the most important? It was timing, which means that timing, you could have a wonderful idea, wonderful team, all the capital, and still fail. So in my startup right now, I've been sitting on the idea on and off for 20 years. I've attempted it 3 times. Last time, 5 years ago, I shut it down and I'm starting again. The point I'm saying is that you have to be ready with your idea and execution and team and everything and get your timing just right. I don't know how many people have that runway to be able to do that. So my advice is, if you have an idea that is taking advantage of the current crisis. So for example, if you can invent a ventilator or masks or a different way of doing business or take advantage of any of these things that are happening right now, this would be a wonderful time to launch a business, provided you can have a team and capital as well. And many people will line up to give you capital. But if you have an idea that is a nice to have rather than a need to have, you might struggle for years to come. So it just really depends. It depends on your skill set, depends on what your idea is.
Can I add?
Sure.
Yeah, please.
So Amit, it's also a big function of the industry that you're going to open your startup in. So she already gave a couple of examples. If you're starting up in a space like packaged food, we know that the demand for packaged food is going to be much more than going to a restaurant, dining out there, right? So packaged food space or financial services, which is least impacted given the crisis that we have, or ed tech, educational technology, or any other technology tools which are facilitating work from home facilities. It's also a function of healthcare or pharma opportunities that we have. Anything where the industry is going to boom, it's going to be taking advantage of the change, the new normal that we are about to create through this crisis. Startups in those space are likely to take off really well. You just need to have a good idea, as Hansi was saying, and the right skill set. And obviously the timing plays a very important role, but opportunities are still out there. So your startup can be still very successful. Be careful choosing the sector that you want to work in.
Okay. Thanks. The next question is to Sangeeta. Yep. The query which is coming out is mostly, it seems, from professionals who are still transitioning in their roles or they want to upskill. What they're worried about is this the right time to go for educational loan, or should they commit their own funds for this upskilling?
Right. Education is definitely good. Yes and no, because it's subjective to see how is this upskilling going to help you further. Because if you have enough experience, sometimes experience only matters. Or sometimes it's just that they need a combination of the two. And it's very rare that they're going to rely only upon their education. So you will have to see how best it's going to help you. Even if you take an educational loan and you successfully complete the course, are you guaranteed of a good, well-paying job? And if you have that, only then you'll be able to repay your education loan. So you'll have to take a very calculated call there to see how exactly it's going to help. See, for example, let's say if you're going to do an MBA from a premier institute, then you're sort of guaranteed. But if you're going to take the same education loan for, let's say, not such a premier institute, then you don't know what is your capacity to repay the loan, and it shouldn't be a fact that you're stuck in debt because of that. So take a conscious call to see how it's going to help you in your career and to progress, and your capacity to repay the loan.
Okay. Anurag, this question is to you. A very unique question. I had to sort of pick it up. What should a housewife, a typical middle-class housewife, what should her financial goals be in this COVID crisis?
Okay, that is very interesting. I'm glad that answer came, the question came. In the last couple of months, I think since the middle of 2019, we've seen an uptick of queries from women investors. Unfortunately and very sadly, just 3% of Midnanswer's customers are women. the number of accounts held by women are way more, but the actual decision maker being a lady is actually just 3%. So we set out on an exercise to understand why is this the case. And one of the most we had two insights. We gleaned two insights. Number one, confidentiality. A lot of women investors wanted more confidentiality than their male counterparts. Some of the questions that or the requests that we came across were that, don't send any physical letters, account statements, etc. Don't courier them to our house. So we took that request. From an investment point of view, there is actually not much difference in terms of there's a lot of research, a lot of literature out there which says that some say women have a high risk appetite, some say women have a more lower risk appetite. But in my experience, it is absolutely the same across genders. However, what I've noticed is that women like more consistency in their returns. So the standard deviation of returns should be lower. So it is just that, and that can be achieved via multiple mixes of investment products. So my conclusion from that would be, you can, if you're a housewife, your investment pattern is no different from anyone else's. You stick to the same mutual fund SIPs, and you're really good to go.
Okay. One last question, Amit. If you would like to take this one on, with the way oil is performing, do you see this as a sector in which there is any hope that there's any investment that anybody should be planning, either toward skilling themselves towards this corporate sector to find a job or to invest in it?
Yeah, I mean, good question. And to be honest, I don't have an answer to this one, because I don't know. So there is one part of oil being a necessity, and there is another part of financial markets, trading and hedging and all those practices to manage oil. I definitely see less reliance on oil as a general shift, of the countries. The reliance on oil is going to go away with time. There's a lot of emphasis on these battery-driven cars and auto-driven cars and all those things. So I don't know, to be honest. I don't have the subject matter expertise to comment the employment-related aspects of oil industry, but I definitely see less opportunity out there, and I see more opportunity in the technology space. I see more opportunity in the healthcare, pharma space, financial services space. Yeah, I mean, I'm inviting other panelists if they have an opinion on this one, because of my inability to give an answer.
That's okay. We will let the people who specifically want a response to this question to connect with the panel on LinkedIn, because otherwise then it becomes unproductive for everyone. So thank you for those insights, Amit. Before I sort of carry on with the further question and answers, attendees, please, here is a poll that I'm launching now. It asks a few simple questions in terms of, what do you think about the webinar, so on and so forth. Let those questions still keep coming in, because I am going to be taking up the mantle of, asking all the questions now. But before that, let me launch this poll, and it's online now. With that, all right, so it's over to me. Now let's see. So this one, all right, so this one is somebody who's sort of not comfortable feeling their name, so it is an anonymous attendee. They're asking, is there a possibility that the entire large parts of the value centered, say, in the market in the last decade or so will be wiped out completely? So I think this question can be actually addressed to both Anurag and Amit. So if Anurag would like to start it, then
I didn't catch the question. Can you repeat?
Oh, sorry. So, okay, I'll repeat it again. Is there a possibility that the entire or large parts of the value-centered people in the market in the last decade or so are going to be wiped out completely this time around?
Okay. So I guess we're talking about deep value investment or value investment over here. There are a lot of empirical research which points in that direction, but saying that value investors they're going to become dinosaurs and go extinct, that is completely wrong. There's no absolute wipeout happening, but there's a lot of empirical data showing that value investors or value as an investment strategy is going to underperform momentum as an investment strategy, and that is for the sheer amount of liquidity flowing into the markets. More liquidity flows into the markets, our markets tend to move higher, and lesser the volatility. When liquidity drops, when there's a liquidity squeeze, markets become more volatile and markets tend to drop. So I do not think there is going to be a complete extension of value investors, but the returns from value investing is going to be lower than growth or momentum investing.
Thank you for that, Anurag. Amit, would you like to add?
No, I agree with Anurag,
Mm-hmm.
more or less, and I think it's going to be more towards new age. So yeah, growth will be the focus,
Mm-hmm.
with the cost coming down significantly, with more efficient products coming there in the markets. I think the emphasis, the average ROI on value investments should start to come down, but there will be other opportunities to have the growth momentum and the ROI advantage kicking in because of the new industries or new businesses which are going to emerge out of this crisis. So we have both sides of the coin here, upside as well as the downside.
Thank you very much for that. So the next question is directed to Sangeeta and Hansi both. This is from Piyush B, and Sangeeta, I would like to for you to address this first, please. To have a passive income, do you think binary option trading is a good option? Should we trust binary option trading as there is no governing body? So trust factor and whether that is a good option or not in the first place. Sangeeta and then Hansi. Thank you.
Yeah. In my opinion, I wouldn't be too much in favor of it, because simply like you nailed it, there is lack of trust and not great proper regulations to do that. So I would advise not to opt for it unless you have some extra cash and then you are ready to go with the risk and play around with it. Hansi, what do you think?
I would say the same. It's not a skill set that I have, and therefore I've not looked into it. My simple point would be back to my earlier point, which is only do things that you have some skill in, which Warren Buffett calls the circle of competence. So if you think you can do this trading well, explore it. I don't have that skill set, so I've never tried it. My idea of a passive income is to have a diversified portfolio of rental real estate, of bonds, both government and maybe slightly investment grade bonds, infrastructure, and things like that. That would be passive income. So yeah, there is something that I invested in some years ago, which I got my hands burnt in. So I would definitely not recommend something I know nothing about.
Thank you, Hansi, for that. The next question is directed to Anurag. Anurag, this is from Kavi Sahani for you. It says, can you throw some light onto the hourly what is the trends and the prices that are currently on for Zoom? No?
What?
Oh, no. This is a missed question. This is totally a missed question. Hang on. No. This is pertaining to Zoom training, but that's something. Right. No. Okay. So this one, Hansi, is for you from Vitika Nayak. Hansi, if one wants to get into finance education, what would you suggest? And I think this is a very important question, because at this point in time, a lot of students are also, evaluating the options. They are choosing streams and so on and so forth. So I think this needs to be addressed. So please go on, Hansi.
I'm confused. Are they wanting to learn about finance for their personal portfolio?
No, this is for pursuing finance as education. Choosing finance option for further education, for degree.
Oh, okay, so a career in finance.
That's right. That's the one. Yeah. This is from
Okay.
from
because I am in financial education. That's a business. So you're technically in the education business, right? I'm in the education business. I used to be in the finance business. So now, this question, I've done quite a few videos with Franklin Templeton on building careers in finance. I also I participated in the CFA career guide. So let me just take a step back. I wanted to be a stockbroker years and years ago without even realizing what a stockbroker does. Similarly, today I find kids, when I go to colleges, and I speak at quite a few colleges, everybody wanted, the last 10 years or so, everyone wanted to be an investment banker. Latest, in the last year or so, I've seen everyone wants to be a venture capitalist. The reason I guess I'm saying is these kids are probably doing the same mistake that I did 30 years ago, which is we find finance fascinating because we see finance people doing really well. And therefore we want to be in finance. But within finance, there's a whole bunch of careers. You could be an economist, you could be a financial analyst, you could be a fund manager, you could be an investment banker, you could be an accountant, you could be a actuary, you could be basically very different. So one, I'd say that whole thing that finance is only about numbers, that's not right. Finance is more about human judgment than people like to give it credit for. So if you are interested in a career in finance, that's fantastic, especially if you're a woman, because we need more women in finance. When you leave it to the men, crises happen. This is just a underhanded swipe at the men, sorry. But that aside, it's great, but please do your research on which career within finance and figure out whether your skill set, your temperament is a good fit for that. For example, Amit is a wealth manager. I used to be one as well. My mother is a wealth manager. That is a fantastic career that you could do for the rest of your life and build a good, rewarding career, if you will. So choose your thing within finance and then do your studies accordingly. So if you want to be an analyst and fund manager, go and do the CFA. If you want to do something else, then there might be a whole bunch of other courses. That would be kind of my answer.
Thank you, Hansi, for that. Anurag, over to you. Now, this one is really interesting. Again, somebody, who's not comfortable coming out in the open by saying their names. It's an anonymous attendee. Very specific, very pointed. Any debt funds to avoid investing in currency, Anurag?
Repeat the question, please.
Sure. Any debt funds to avoid investing in currently?
I would invest in debt funds which invest in bonds and debentures or commercial paper that have a shorter duration. I will avoid investing in debt funds which invest in bonds that have a longer duration. Longer the duration, the more sensitive it is to interest rate risk. And in times like this, RBI will change interest rate risk because there's a lot of hodgepodge going on. Inflation rises or decreases. So RBI's outlook towards the economy becomes very short term, becomes very, very quarter to quarter. And so the interest rate changes, I don't want interest rate changes to affect my investments per se, obviously. So I will invest in debt funds which invest in short term or short duration commercial paper. I think Amit, you could probably expand a little more on that.
Yeah, sure. So if the question is which ones to avoid, definitely avoid credit risk category, even though it's being called out that it's one of the fascinating category given the current times. I would go for low duration, ultra short term, and liquid funds only until we stabilize.
So any debt fund which invests in short term duration commercial paper or instruments.
Yes.
Right. So that brings me to the next question. And Amit, this one is especially for you, by Srijan Shetty. So he goes, you said that it's good to stay invested right now, but the performance of sectors might change completely after this pandemic. So is it good to have that diverse portfolio or concentrate on certain sectors or move the investment to debt funds? What would be your take on that?
Yep, very good question. And I would recommend stay away from doing your own analysis about the sector and the business and the company and the people and the management. You should trust the fund manager, let him do that part. It's a part of his responsibility when he's managing the fund, which sector to get in and which sector to come out of. What you need to focus on, your financial goal and the horizon that you have. If you have a goal which is beyond 5 years from today, map that goal to a set of financial assets which have exposure to equity mutual funds or any other equity related products. If your goal is within 5 years, keep your money in debt funds. You can choose ultra short term, or even medium term duration funds for the next 4 to 5 years. Beyond 5 years equity, and in the equity, you don't have to take the call on which sector or which thematic fund to follow. You can choose a good multi-cap and a good mid-cap fund and a large and mid-cap category, and let fund managers take that call. You track the performance of the scheme. You track how cost efficient the scheme is, what has been an alpha which has been created by the fund manager over the index. And if you are seeing that the alpha is not generated, switch over to index funds. We have tons of options now in index funds. You can choose Nifty 50 index, you can choose a multi-cap or mid-cap index fund. You can also choose NASDAQ 100 index fund, which is given by Motilal Oswal. So take a call, and my suggestion is let fund managers do their bit, and you choose an index fund or an actively managed mutual fund which has a record of continuously generating alpha over the index.
Thank you for that, Amit. And that brings me to Anurag Youth. Here's somebody anonymously again. You mentioned to use advice services for stock recommendations, but being a newbie in the market, I cannot afford those advisories. Is there any other alternative out there? What do you suggest?
There's a lot of literature out there already, and someone new into investments actually does not need paid advisory services. You invest in some mutual funds. How Amit, what Amit said, you can invest in index funds. If you don't want to select a mutual fund, you can invest in a in an index fund. You can mix and match between the indices. You can have a mid cap index or a equity large cap index, and you can also add the Nasdaq 100 Motilal Oswal's mutual fund for some global exposure. Gold can be purchased through Paytm's app itself, so it's completely DIY. You don't really need a advisor services when you're just starting out.
Right. Okay. Thank you for that. Hansi, Ankita Poddar would like to ask you, given the current COVID-19 situation, how would be the job prospect of business analysts, data scientists, and data science engineers in case they want to take a course now and opt for such kind of roles? So business intelligence kind of roles, what will be the future prospects?
To be honest, that's not my area at all.
Not a problem. Not a problem. Anybody else would like to take that? Otherwise, we can pass that, and I would be happy to pass that on to our HR panel or something.
I would have thought data, anything would be useful. But yeah, sorry, anybody else wants to take it, that would be a better answer.
What's the question again?
Yeah, the question is, given the current COVID-19 situation, how would be the job prospect for business analysts, data scientists, data science engineers, in case they want to take a course now and opt for such roles? So
I don't think it will change at all, really. I don't think it will change at all.
To be phenomenal, you can pursue that because it's all going to be all algorithmic stuff now. So one of the things that you would notice, the information relay is much faster than it used to be 10 years ago. So it's often said the recovery from 2008 crisis took about a year and a half, and recovery from this crisis will probably take just a couple of quarters because it's all so computer generated now. So data scientists, data analytics is still going to have a great career because that is the crux of the AI space altogether. So, we need AI, artificial intelligence in every business now. So I would stick my neck out.
But Amit, what did you mean by we will recover from this crisis within a couple of quarters? What do you mean by that?
So by that, I mean the information is now going out so fast compared to how it used to get transferred from one set of people to another, that the recovery is going to be really, really fast in terms of establishing the same stock level index, same index levels.
I don't know that I agree with that. Not because I'm saying it won't be. I'm simply saying we don't know.
Okay.
That would be just my 2 cents. But yeah.
Right. Anurag, would you like to add to what Amit has just said before I move on to the next question, please? Because
I'll agree. I'll agree with Amit, and I don't think there will be any change in job prospects for data science engineers or business analysts. If anything, it will just be better.
Right. Okay. So there still are very many questions, dear attendees. Once again, reiterating the fact that please, if there are any specific questions, reach out to our panelists over LinkedIn via a personalized message, and then you can dive deep into further questions. At the same time, last but not the least, I will just take one more question, and that will be us done for the day. And the question is, all right. So again, another anonymous, and everybody can add their 2 bits over here because it's a very sort of generic question. It says, because of the fund crunch, fund sellers as well as fund houses are becoming desperate and want money from the investors at all costs. How do you avoid putting money in such circumstances and in such instruments? I think this is a question warranting answer from all of you. So,
Okay,
please,
I want to go first on this one.
please.
I spent my whole career in fund selection. Okay, I'm a CFA, worked for a small company, then Mercer. So literally all my whole career, I was advising the NPS on their fund selection, a whole bunch of them. I agree with what Amit said earlier, that if the debates on active passive that I see in the market all focus on whether or not active funds have outperformed or underperformed. Whereas I think the questions are threefold. Can it be done? So can active outperform? Is it done? And three, can you do it? And what people tend to forget is looking at the debate of whether can it be done or is it done, they forget that can I actually pick my mutual funds? When I say I, me or my financial advisor. I don't see financial advisors subscribing or doing original research on the fund selection bit. I don't see them giving written advice to their investors. I don't see them even measuring the value add that they have in the fund selection. I'm simply saying it's a hard problem to solve. It's not as simple as let's take a Morningstar star rating or a Valley Research star rating. If that was that easy, every pension fund in the world would simply take the Morningstar star rating and just be done with it. They wouldn't have a consulting industry. They wouldn't have their own evaluation at all. I'm saying fund selection is a very hard problem. It's not as simple as you think. Therefore, I agree with Amit that I think it's good, useful place to start is simply start with passive. Start with an index fund or an ETF, build your core up, and there's plenty of free education available on the net. My site is one. I'm sure there are thousands and millions of sites that do it. Find credible people and go and learn about how hard a problem this is. And once you've mastered that, then go and start adding active funds in the asset classes that you think that you can actually, they can actually outperform in.
Right.
So don't fall for the fund house advertising is my 2 cents.
Thank you, Hansi. Amit or Anurag, who would go next?
I agree with Hansi completely. All these fund houses are businesses and they're in the business of managing money. And they always charge a percentage of the AUM. So the higher the AUM, the more the money they earn. I think fund selection, like Hansi said, it is that I think you can do another similar session on just that one topic some other time. That fund selection is so hard. It is actually better if you stick with index funds. And if I see a fund house which is aggressively selling all their funds, I would like to see a drop in their management fee. That would show me that they're actually serious about managing more money. I do not like to invest in funds that have an extremely large AUM because it makes it hard for the fund manager to deploy money in all stocks. I remember this happening to the HDFC Top 200 fund, which at one time was an absolute juggernaut, the juggernaut of mutual funds, and it was holding something around 212 securities or somewhere near that, and it went beyond this universe of the top 200 mutual funds. So I would like to invest in medium-sized funds, and if they're selling aggressively, I would like to see a reduction in the cost.
Thank you for that, Anurag. What are your views on this, Amit, please?
So very simple. Every business has its sales and marketing team. So I wouldn't get worked up if somebody's approaching me to buy their product and service. It's just my judgment. If I need it, I'll buy it. If I don't need it, I won't buy it. Or if I don't like it, I won't buy it. So there's no reason for anybody to get hassled if somebody is approaching you to buy something. Just treat it as per your needs. So purely financial planning, your financial goals will determine where you would be investing your money. And if you don't have an advisor, then you will do your own research to identify your opportunities of investments. And if you do have an advisor, you will work with an advisor to figure out how he's adding alpha, not necessarily through by a selection of funds, but there are other ways an advisor adds alpha on the behavioral coaching side, on the cash flow management side. Lot of things can be figured out in your engagement model with the advisor and how he's going to generate the alpha. So choose a scheme, choose a fund based on your own research, their cost structure, their performance over the period of time, and the size of the fund house and the quality of the fund managers they have onboarded. and the performance these fund managers have delivered. And of course, work in tandem with your advisor if you have the advisor. I would suggest onboard an advisor because it just makes the whole thing very objective. It just keeps you away from your biases and it keeps you aligned on the course of action. And stay focused on financial goals more than your investments, because the idea of investment is fuel in the car. The investment is taking to the destination of financial goal. So keep your eyes on the goal and the optimal performance of the fuel, which is your investment, to help you get to your goal faster. The moment you reach your goal, exit. That's the whole idea. If you are about a year, a couple of years away from your goal and your money sitting in equity, just move your money out and into safer asset of debt funds or liquid funds and let it be there. So be goal centric rather than market centric, and don't give too much attention to products. You can still achieve a lot with simple products and very simple engagement model with your advisor. That'll
Right.
be my take on it.
Thank you, Amit. So, attendees, last but not the least, again, please reach out to our panel on LinkedIn because there still are a lot of questions. You answered the poll. Quite a few of your questions have been addressed today, but unfortunately, there's only time for so many. We are about, close to our 90 minutes of what we had planned for today. The rest, please reach out to the panel. At this point, thank you to the attendees for
Sorry,
being here. Just one moment, please. Or go ahead. I'll come back. Go ahead.
Just Preeti, just on that point though, a lot of people can't send me messages. LinkedIn has disabled my direct messaging thing. So you can't send me contact requests or messages. So I have a page, The Money Hunts, and I post a lot of stuff. Use the comment bit to put your questions in, and there's a handle and email available pretty much in all my media. So just answering your LinkedIn thing. If you
Sure.
can't get through to me on LinkedIn directly, please use my page.
Right. So on that, thank you for that, Hansi, for that tip. But coming back again, so yep, thank you to all the attendees, first of all, having spent 90 minutes with us, learning, leveraging each other. Thank you to the panelists for sparing us your time and your expertise and listening and bearing with us. Thanks to our partners, which is Reboot Digital for our creative and digital marketing, our knowledge partners, City Book Leaders, our virtual incubation partners, Incubation Masters, our incubation partners, AIC Raise. Vivek, Amit, and everybody else on the team, thank you very much. And once again, let me just remind you, we do a LinkedIn Local India Community Connect Social Lounge every Friday at 5 p.m. And our knowledge sharing session, which you were a part of today, is every Wednesday at 3 p.m. So the next one is on April 29th. The topic is preparation for a post-COVID world. On that note, thank you once again. Bye, everyone. See you soon.